I appreciate you all coming. It's kind of neat looking at where people sit. I'm used to normally there's a lot more people, but some sit at the front. It's just like a class at school, right? The more anxious students, the more, I think the ones who actually normally get the better marks, they sit at the front, they're keener. The ones at the back are, more dubious students, so to speak. So given that we have this disparity in terms of who's here, where you've sat, and afterwards I want you to think, if you haven't already sorted out, why do I sit where I sit? And then you might ask yourself, do I always sit in about the same place? And then the question I want to talk about is, schizophrenia. You think we're going to talk about investing. We're really going to talk about schizophrenia today. So all of you who are schizophrenic, I want you to leave your hands down. Well, that's perfect. I've got a completely schizophrenic audience here. Later on, by the way, if you don't know, in the North Building, the psychological conference is on, all about schizophrenia. So those of you who aren't on your medication and are thinking of having some, you might want to head over there later on. But I think schizophrenia is a wonderful topic right now because, to me, the stock markets have been exceedingly schizophrenic. And I don't think I'm telling anybody anything that's a surprise. You might not have thought about it in that way. You might have just thought things are crazy, things are insane, things are like at any point in history. They're not even like 1932, 33, 29. Because the rebound that we've had has been so much more marked than the one then, although there was a big rebound before things went way down again, that this is completely different in many ways, shapes, and forms. And I have a theory on why things are so pronounced, and you might have heard it from other people, perhaps even more eloquently. But I think that so much of what we're seeing now is catalyzed, stimulated by the internet and by information. Everything is coming to us way more quickly. Now, some of you who know me know that, I generally don't wear ties. I do to family occasions. I do the odd time when I'm on BNN. As a matter of fact, Mark at the back who works with me, he sometimes actually, even though he works with me, he can't get quite enough of me sometimes, or he just wants to make fun of me afterwards. And he'll watch me on BNN, and when I'm wearing a tie and a suit, which again is pretty rare, he says, what's going on? What's going on, man? What are you doing? He doesn't talk exactly like that. You could talk to him after, he just gave you the down signal. But generally, I don't wear ties too often. I find that, they're tight. I also don't have a BlackBerry. Can you believe that? Like a guy involved in the market without a BlackBerry. So I don't know what's going on right now. Actually, I do. Markets are even. Exactly even right now. So if any of you were worried and wanted to look, the TSX, 0. The Dow, 0. So I'm keeping you up to date. Once we hit 9:30, I'll be a few minutes behind the times. I also have a cell phone now. I used to pride myself on not having a cell phone. It just shows that I can change. But once we had 2 kids, with kids, life got more complicated. So I got a cell phone. My plan is good for 36 minutes a month. I've only gone over once, and that's when our bell service was down for 3 days. That is not a knock-on bell. There'd been a storm. So I'm not tied right into things. But I'm sure a lot of you people are. As a matter of fact, there's a man back there now. Actually, he's not here. He's out there. He's still watching to see what happens with Balloon Boy. He thinks it's real. He thinks that Balloon Boy still might not recover. So imagine this event that so many people, from what I understand, I missed it until after it was all done. So many people watched to know what happened to Balloon Boy. Did he survive? I look at it in terms of sickness now. One of the best industries to get into, I'm not saying you should invest in it now, but Why are the drug companies buying up other drug companies to do vaccines? This is like such a great area. Because you know what we've faced since around 2000? Mad cow disease, might have been a little earlier. Mark probably knows exactly what year. He's more up on these things than me. You know how many people died from mad cow disease? There were a lot of cows. A lot of cows died from mad cow disease. Not many people died. Avian flu, I think that might have topped 500 now. I'm not sure. I get it confused with SARS. One of the two topped 500 globally. I'm not talking Canada. Globally, in the whole world. And how many billions of dollars have been spent on this? Now there's something called, it's not swine flu anymore, H1N1, I believe we call it in Canada. Swine flu in many other countries. You know how many people have died from that thus far? I know that there's a chance millions will die, but you know how many have died? Not very many. And I hope you all washed your hands before you came in here. I think we need all levels of government doing a $1 billion campaign to say, go and wash your hands. And that's effectively what it comes down to. And maybe you should get the shot. And still not sure. Now let's go back. Let's go back to 1993, which I consider to be pretty much pre-internet. I was on in 94. You know, it's Benj on internet. Internet exists. Most people got on a little later, I think. All this news, you might have read about it in your newspaper. You think that H1N1 would have been front page news? Maybe for a day or two, but it wouldn't have been everywhere. Swine flu wouldn't have been everywhere. Avian flu. But all of a sudden, you've got all this information bombarding you at all times from so many different places. This is a crowd that's mostly over 35, 40 years of age. I don't know how often you would have checked your stock market quotes back in 1990. But now, how often do you check it every single day? How often do you have to know what's going on? Right now, we have this incredible information overload being pumped in our direction. And I personally think that it is an overload. And I think to some degree, I got caught up in it. And that was a mistake. Because most of this information is noise. When I was buying into a lot of the bank stocks, starting at about December last year, you could find information on both sides. And when I bought into Freddie at 68 cents, it was going to be worthless. Most of the pundits said, in short order. A few thought it might be a good investment. I sold it a couple months later at $1.08. I wish I had held to $1.60. Unfortunately, I didn't. You can find people to argue on any side of an argument now and in multiple quantities. You can go and look at their blogs. You can go and look at Twitter, is that what it's called? Twitter. All 140 characters of it. You can get this information all the time. Now, fortunately, this crowd is a bit different than when I spoke at Dalhousie University, one of my alma maters, a couple weeks ago, because there were people there suffering because Miley Cyrus was no longer sending twits. I mean, you know, it's like you got to detach yourself. So I think there's way too much information, and one of the best things you can do as an investor is cut a lot of it out. I'm not saying cut out all information, but you really have to sift through what makes sense and what doesn't make sense. And as I started to say, I think I'm kind of guilty myself of getting too caught up in everything. Now, we made a decision last year at the Contra the Herd investment letter. We bought 3 stocks in October, November. We bought Yahoo, we bought Motorola and Richmond Mining. And then in December, when we normally do most of our buying, we didn't buy anything. And we sent out an email release to our subscribers saying, we're not going to buy anything because we're quite worried about what's going on out there. Well, of course, in December 2008, just about everybody was worried about what was going on out there. Our thinking was not contrarian, contrarian being going against the grain. But back in July 2005, you don't have the contra that had it. You have one earlier in the year from January. But in July 2005, we wrote our front page article was on the upcoming darkness. Because we looked ahead and we saw that there was no reality anymore. There was so much debt, corporate debt, personal debt, credit problems. The leverage out there was insane. Real estate. You know, people buying homes with nothing down. Even the CHMC here started to do it. We wrote an article including that. How stupid can you be? Because, of course, back in 2005, a lot of people thought, well, housing prices can never go down again. All they can do is go up. They don't remember around 1990. This is a good crowd for me because a lot of you remember these things. Because in the early 90s, real estate prices started to go down. But again, around 1988, a lot of people thought they couldn't. Now, when I was looking to buy a condo, it was 1994 because I thought the market was near the bottom. And actually, it was one of the ones I got right. But let me tell you, I get lots of things wrong. As a matter of fact, I get so many things wrong that though our long-term results, 15-year results, were amongst the best in North America, and until last year, we're up over 20% for 15 years. But then last year, we lost about 36.8%. Now, what that doesn't include is the cash that we had. And we'd moved a lot of money to cash, so we had over 50% in cash. So our loss would have been a lot less. But we always base our returns strictly on the stocks in the portfolio. I wish we had taken more money off the table. Unfortunately, we didn't. I wish we had bought less. Fortunately, we didn't. In December, when we sent out the email release saying we weren't buying anything, a few months later, we looked really smart. Where we didn't look smart was in March, we weren't buying boatloads of stuff, February, March, April, and I wish that we had. And I think part of the reason we didn't was that I was too caught up in all the information that was smacking me in the face. Fortunately, this year we've made somewhat of a recovery. We're up about 44% before including the Canadian dollar, which knocks us down about 9%. So we seem to be coming back into form. But this gets you into psychology and emotions. What happens when things are good? People join the party, they invest like crazy, the hot mutual funds, people go into the hot mutual funds. And they don't care, a lot of them, what the MER is, the management expense ratio. You know what? You guys can take your share, but as long as I get a good return, that's great. We look as contrarians as what's cold. So say after 1990, before we were actually doing the letter, but we were certainly investing, in 1990 we lost, I think it was 17.2%. And I looked at our portfolio of 16 stocks. Normally we have 15 to 25. And I saw that only one was up and 15 were down. And I thought, wow, we have the best portfolio we have in years. Because I knew there was so much more upside from when we had bought the companies. We did not lose money again until the year 2000. Every year we made something. Matter of fact, after 1990, we had 3 years in a row. I think our lowest gain was 47.3%. Then in 2000, we got knocked. We didn't get knocked in the same way because of the technology bust, because we only buy companies, and this is something that makes us different, that have been around for 10 years. I've learned over my 30 years of investing that IPOs, most of them are down in value a year later. I don't touch them. So that's key. Because I won't touch anything new, in 98 and 99, anything with a .com label was hot. So we weren't buying them. So we didn't get beaten up on that. We lost about 22% because of the other mistakes we made and because of the market. And at that point, we were publishing the letter. We had a great track record. But people didn't want to sign on. And we wrote in our January 2001 Contra, we feel that we've got the best portfolio that we have in years. And why was that? Because so many of our stocks were beaten down. And that was a time people should have been subscribing. That was a time, if you're into mutual funds, you should have been looking at some of the cold mutual funds, not the ones that were hot. For the next 3 years, our lowest return was about 50% per year again. Now, again, that didn't keep on happening. Every year was 3 years and then went down. And we could see this was going to happen. So in January 2003, because I think at that point, of the 25 stocks we had, they were all up in value. Complete aberration. And I thought, this is awful moving forward. It looks really good. And people were subscribing in droves. We only take 1,000 people. And all of a sudden, we had a waiting list of 300. But it was the wrong time to subscribe. People thought, you guys can't do anything wrong. Well, we knew we could. We'd done lots of wrong things before. The next time that we wrote about what a great portfolio we thought we had was January this year, because we got badly beaten up last year, and we lost actually money the year before, about 6% and change. So if you're going to take something from that, the key thing is, I believe, to look at things that are not hot, that are out of favor. I'll give you a couple more examples of our thinking. In 2002, I guess, when I was doing the book tour for the Contrarian Investors 13, we had just bought into KLM. Now, before that, we had 9/11. So what happened naturally was airline travel went way, way down the toilet. Besides the fact that you had a lot of airline companies that had incredibly poorly leveraged balance sheets, you now were dealing with a market where people didn't want to fly. I thought it was probably one of the greatest times to fly because the airlines, the hotels, there were bargains galore. It was saying, Benj, go fly, take trips, take trips. You can save hundreds of dollars right now because people won't go. You'll go to a hotel and they'll actually boost you up for no money. I like that. At the same time, we had bought into Japan because Japan had been out of favor for about 10 years. A lot of people said Japan will never come back. Well, it actually has not come back as I thought it would, but it's certainly gone up and down, so we got to sell out of Japan. KLM we sold and did exceedingly well on. They merged with Air France. They had a pretty good balance sheet. Anyhow, it's the key from what we do is this contrarian aspect. But we're not just contrarians. Within our system, we use a lot of other systems. And a lot of other systems work. So when we're buying our stocks, I can't remember the last time actually it's not true, we bought Yahoo at 11.11. Prior to that, I can't remember the last time we bought a stock over $10. When we buy our stock often under $5, what happens when they get to $5 is a lot of mutual funds and investment institutions can buy them. Others are $10. They cannot buy a lot of them under $5. So we get the momentum from that. Then we also get all these banks and brokerage firms saying, oh, you should buy this company at $14. And our target price is $16. Well, to me, buying something at $14 with a target of about 12, 15% higher isn't really worthwhile. Again, we're almost always looking at least 100%, often 200, 300, 400%. Of course, they don't always make it. Of course, if they all made it, we wouldn't be selling sometimes for tax losses. But that's the nature of the game. If we have stocks go up 200, 300, 400%, that offsets the losers. And that offsets the ones that take longer to do something. We do not believe in buy and hold. Some of you probably used to believe in buy and hold and no longer believe. I think that buy and hold is stupid. I think Warren Buffett is a genius. I actually went with my business partner, Ben, who many of you know, Ben Stadelman, who would have been here today, except on Monday he got a herniated disc. So he can hardly walk right now, and thank you, Mark, again for stepping in. So Ben cannot be here if you were here to see him. Just the way it goes, he can hardly walk right now. So key here is in terms of our way of thinking, we look at fundamental analysis, we look at technical analysis. We're very strong on financial ratios. We do not like debt for the most part. And again, we buy a lot of stocks under $5. Now, I just had one thing that is a complete historical aberration. We often talk about the mistakes we made. I mean, a lot of people have wanted to know because in last April's Contra, we wrote about MBIA as a possible selection for subscribers and Bank of Ireland. And Bank of Ireland was kind of a classic play, but it was gutsy and in some ways I think almost to the point of being stupid. But again, I remember back when Bank of America, and we're going back now to around 1990, Continental Bank, Continental Illinois in the States, the banking sector in the States, they were saying, was going down. Some of you may remember this. So we bought Bank of America at $12, Continental Illinois at $4. Logic dictates if you can stay away from emotion, you know, the schizophrenic side of you that's really emotional, the other side, if you can stay away from it, you know that the banking sector in the States will keep on going. Question is, which are the winners going to be? Very hard to know. So when I was acquiring these companies, I knew some would be failures. Now, Bank of Ireland, obviously not in America, but Ireland has 3 major banks. Anyhow, I chose that one to buy. I quickly sold it for a tax loss and lost about 40% of the investment. And then I bought back in after 30 days, because you have to wait 30 days for the tax loss, at $1.60. And psychologically, that's difficult to do. Already lost on an investment and then buying in. This is not averaging down. This becomes a different investment. I do believe in averaging down. A lot of people think it's stupid. But I've learned over time that generally I will only average down once and say, well, I'm not going to do it again. Some people will average up, or they'll do dollar cost averaging. Dollar cost averaging to me is just stupid. They take some money from your paycheck or wherever every month to buy something, no matter what the price. You would never do that in any other part of your life. Shoppers like me, perhaps cheap. I love waiting for Boxing Week or Boxing Month in January to buy things at half price. If I buy it mid-December, for television it may cost, I don't know, $1,000, $1,500 for something with a couple bells and whistles. But I know by waiting I can buy it for less, so that's what I do. Dollar cost averaging, you're not doing that. You're just buying and paying whatever the market says. And the market is often wrong. But going back, Bank of Ireland, I bought it at $1.60. One of the Irish banks got nationalized, and all the noise out there was quite possible. A lot of people thought the other ones were going to be nationalized, go bankrupt, and I didn't know. What I did is I looked at the risk and the reward. And I thought the risk here is I can lose virtually all my money and sell out at 7 cents after they go bankrupt. On the upside, though, I was buying into a company that for year after year after year had traded at over $60. So it was insane. The upside was absolutely huge. Now, it's quite possible it wouldn't go that high anymore, government stake, etc. But $30, $40, the rewards were high. Now, again, complete aberration. Within 7 months, I sold off 53% of my position at $16.60 for a 10-bagger. It immediately went up to $19.20. It's come off a bit since. But it was a good weighting of risk and reward. Now, at the same time, as I mentioned, I bought a lot of other financials. One of them was Irwin Financial. So I was diversifying my risk in a sector. So I'm a great believer in diversification. I am not a believer in over-diversification. Some people buy so many mutual funds that they end up working against each other. In the portfolio, as I mentioned, 15 to 25 stocks. To me, that's enough diversification to have. Irwin Financial, that I paid, I think it was 86 cents for, came down, but then it flew up to about $1.40. But I thought it could go much higher. It looked like a turnaround was in play. And then it collapsed. They had bad results. The federal authorities in the States had a cease and desist order which is often a harbinger that the company will not trade much longer. I jumped out at 48 cents. Now it trades at about 6 cents. So I took a haircut there. So you can see the haircut I took. But again, offsetting it was this absolutely huge gain. And we're always trying to offset our risk and not lose too much money on any positions. And for years, we actually didn't. And then over the past 2-3 years, we had some blowouts like Abitibi and Signal. We've set something in place now we think will help to offset those blowouts too. So a lot of people ask, how do we set our target prices? Whenever I buy a company, I always set a target price. To me, that's absolutely critical. Again, because we're going back 10 years, we know where the company has been. So we'll look at where the company has traded, say 7 to 8 years. If it's traded at a much higher level, we'll basically take the low end of the high range and add about 10% because it's over time that we'll look to sell. We're going forward. There'll be normally inflation, etc. Our average hold period is 3.5 years. As I mentioned, I don't believe in buy and hold. But for some people, 3.5 years, when I say that, they say, oh my God, you hold for so long. That's absolutely crazy. How can you hold for so long? Now, if our average hold period is 3.5 years, that means we're holding some for 5-6 years. We've actually got Highliner Foods since 1993. But then I don't think there's anything before 2000, but I'd have to check today. So we have a different way of doing things, a different way of looking at the markets. Now, literally yesterday, I was at the CIBC meeting with the financial planner there. I talked to people outside of the mainstream and in the mainstream. And this is a very educated woman. And she's also a CA. She really knows what she's doing. And I have too much money in I'm happy, sitting around now because I'm trying to get higher rates for it. I don't put all my money in stocks. I think that's just stupid to do. I have money in GICs. I have money in bonds. Fortunately, I can do that. Plus, I own my house. If you want to take any piece of information from this in terms of investing, I think the best thing you can do is pay down your debt. If you pay down your debt, well, you're paying interest, you're getting a guaranteed return on your investment. If you're paying interest rate of 5% and you're in the 50% tax bracket, you've got to earn 10% because your partners, the government, are going to take half of that money. So it's very important to pay down your debt. I consider that to be absolutely critical. And that's but the first thing that I would do. So when we're looking at how to invest, again, we focus also on corporate balance sheets and that they don't have a lot of debt. I don't like seeing debt increase for a company. To me, that indicates that things are not going to be good going forward. There's certain dangers with having a lot of debt. Now, some of you probably want to know my prognosis going forward. In July 2005, we made what I think was a very good call about the upcoming darkness. I thought it would actually happen towards the end of 2006. It took a little bit longer. Where do I think the markets are going to go now? And quite frankly, I don't know. And tonight, as I mentioned, I'll be on BNN from 7 to 8, and Howard, one of his first questions might be, so where are the markets going from here? I don't know. And I'm perfectly content to say that. There's a lot of bulls out there who say things are coming back, but really, in terms of changing the system, in terms of taking this capitalist system, especially in the States that they have, and wringing some of the capitalism out of it that they need to do, getting rid of some of the leverage, getting rid of some of the greed, they haven't done it. They keep talking about it, but in a regulatory framework, they haven't done it. In here, too, the banks keep patting themselves on the back and saying how good we've done. If it hadn't been for Jean Chrétien and Paul Martin, the banks would have merged together, gotten bigger, done all kinds of buying of banks in other countries, and we would have been in a hellacious state of mind, hellacious state economically. Which takes me back to the CIBC yesterday. So what did this woman, again, very educated, well-meaning. What did she suggest to me to do with some of this cash that I've got spinning around at 1.5%, some at 0.7%, so I'm earning virtually nothing on it? Well, she said, why don't you go for a protect your principal kind of deal? And what we will give you is for the next 5 years, you are guaranteed a 1% return, which does at this point beat my 0.7. And I thought, okay. And she said the upside, and I'm not sure that I understood this completely, because I know at TD about 9 months ago they told me the same thing, and it was a little misconstrued, but is 7% a year based on 10 Canadian stocks. Now, of course, the stocks they're choosing are big ones, Royal Bank, Agrium, things like that. If this had been last March, April, May, it might have been a lot more interesting to do because the upside was far greater over the next 5 years. And 5 years is still a long period of time. But to have 1% return for 5 years, again annually, as compared to the possibility of 7%, I decided not to do it. And a lot of people, if you read articles, I mean, they're setting up their arbitrage systems here so that they know they're guaranteed a return. There's so many built-in costs that generally for investors, these things are not that worthwhile. So you've got to watch it. What I also think people have to watch is anything new. Anything new out there, I'd stay away from. And new becomes often the best thing going, and they're all pushing it. For example, the income trusts. Now, a lot of people still curse Halloween in 2006, Stephen Harper, I think it was 2006, and what he did with trusts. How much does this government know economically? We were never going to have a deficit under this government. Now it's about 50 billion, 55 billion and climbing. I think that says a lot about what they know economically. But he was smart to get rid of the income trusts. I would have got rid of them for real estate too if it had been me. But I actually think it was a good move, even though he said they would never do it. Because income trusts pay out so much of their money that it makes it hard for the corporation to continue, or the trust, to continue. So a lot of them, you have probably noticed, have cut their payouts or eliminated them. So they came out at $10, $15, $25, and now a lot of them you can buy at far lower values, of course, without a distribution, or they're converting back to corporations as we speak. But income trusts were super hot. But they'd already got rid of them in Britain. They'd already got rid of them in Australia. If you looked further afield, you could see they didn't make sense except generally for the people who were spinning them out. And spinning them out is a bit of a pun for me because it was one corporation called Spinrate that I remember specifically became a trust. And I looked at the financials for the previous 5 years. 4 years in a row they had lost money. And the 5th year they made it, and they said, let's do it. Now we can sell at a premium. Trusts are hot. People will buy into this. And they did, and then it went way downhill. So I strongly suggest to you, and you can do with it as you want, excuse me, that anything really hot, that anything really new is something to probably be avoided. Plain and simple. That might make your world far less exciting. But part of the question is, do you want excitement or do you want good returns? And I think good returns beat out on excitement every day. Now, in the contra I gave you from 2005, if you look on page 2, you'll see some of our philosophies. And that's pretty much what we're guided by to a large degree. But what we're doing in January is we're actually setting up a second portfolio. 2 for the price of 1, so to speak. What that means is I'm going to continue with the portfolio we have here. And Ben is going to start the vice president's portfolio, which will have more latitude in terms of investing. And part of the reason for that is there were so many opportunities last December excuse me, that we couldn't invest in because they didn't fit into our parameters. So we decided that perhaps it would make sense to have larger parameters on the second portfolio. So whereas in this portfolio, I would never buy anything for over $25, he might do that. So readers of the investment letter will have more choice. So what we're effectively doing is we're going to have another portfolio also based on the contrarian system, but it'll be under that umbrella, but it'll be somewhat different. So readers, again, will have more choices in terms of what they're looking at. So contrarian investing is not for everybody. When we go back to emotion, to invest in companies that have been beaten down can be very, very difficult for people. We have to psychologically set ourselves apart because it's much easier to invest in things that are hot than in things that are cold. And a lot of times, again, people do not like where we go because of that. So you have to have somewhat of a different way of thinking altogether. Now, a lot of you have probably had some of your belief systems shattered because of what has gone on over the past year or so. I think there's a major opportunity because markets move so much more quickly than they used to. And I think we're going to see this going forward. As I said, I believe markets are more schizophrenic now than they've ever been before. I think the pendulums are going to swing more back and forth than we've ever seen before. So if you can actually set yourself apart more, you will have more latitude for big gains than you have ever had perhaps in the past. So I'm actually not saying there's a huge paradigm shift. Remember that from 2000? 1999, but I think there will be more latitude. But there's still some rules that I would not change in terms of we do not use stop losses. Now, a lot of people, as you know, they automatically have a stop loss at, say, 10% below where they buy something, or they have a trailing stop loss based on where the stock is. We don't use them because we know that stocks, the latitude in terms of where they trade, so often we would have been thrust out of a position, and we don't want that to happen. Mentally, we're always looking at our stocks, trying to understand whether their condition has changed if they go down, or whether it's just Mr. Market speaking. Because as Benjamin Graham said, the market's a voting machine. You know, people, if a whole bunch of people look to sell because of their mood that day, then the market will go down. When we do most of our buying in tax loss season, a lot of people are it's like doing your homework just before papers due. A lot of people are selling at the end of the year because they want to take the tax loss. That gives us a chance to buy. One of the things I spoke about at Dalhousie, because it was something I also got taught at Dalhousie and debated about because I didn't believe in it, was that markets are perfectly efficient. Now, markets perfectly efficient, all the information is out there, therefore they come to some sort of conclusion, and the price of the stocks is correct. I don't know if anybody here believes it. It was a major teaching at universities when I was there. I debated with my professor. He thought that they were perfectly efficient. But of course, how can they drop so much in such a short period of time if they are? And I look back to 87 when markets dropped 22.4% in a day. Like, that's perfectly efficient. It's showing all the changes in that one day. It makes no sense. So when you're looking at stocks, it's worthwhile to try and cut through all that. Again, what you want is maybe a schizophrenia that's somewhat opposite to the market schizophrenia. So what you might want to do when you go home, because, you know, everybody here said they were schizophrenic, although some people have walked in afterwards and they're saying, what are you talking about? I'm not schizophrenic. And maybe you want to do a little diagram, like take the stock market and then put an overlay of your schizophrenia and try and work at the opposite to where the marketplace is at. Isn't this fun? I had one professor at Dalhousie, Stig Larsson, who taught us statistics. He was Swedish. And he would put these incredibly complicated mathematical equations on the boards. And he'd look at us, and, we'd all be kind of glassy-eyed. And it wasn't just a glassy-eyed from partying too much. It was a glassy-eyed, like, what are you saying to us? And then he'd just go, isn't this fun? Having fun yet? He liked doing that. If you want to invest, you have a choice. You can invest in a mutual fund where the average MER is about 2.4% every year. Now, a couple of them, actually, I've read about, have decided to not include that expense ratio. Usually they're value guys like us. But most of the big ones have kept on taking it. If you're investing in funds, you want to find one. If you're looking at two funds that invest in roughly the same thing, normally you'll do better if you buy the fund that has a lower MER. Even if it's 1% a year over time, that adds up quite a bit. But I personally think most people can do their investing themselves. It's not brain surgery. The brokers want you to think that. The mutual fund managers want you to think that. A lot of the people on BNN want you to think that. CNN, certainly. They want you to think that. But it's not brain surgery. There's a lot of books you can sit and read and start playing in the market a bit, paper plays before you go in. And then what you can do is you find a discount broker. And you can pay that discount broker $10 a trade. So let's say that stock that you buy and you invest, pick a figure, $5,000, you pay $10 in. If you have $10,000 and it's in a mutual fund, they take 2.4% every year, so $240. Win, lose, or draw. Whereas if you put together a few stocks, you're going to save all kinds of money by buying yourself. So I strongly suggest that you might want to take a look at doing more of the investing yourself. And if not, at least what you want to do is try and understand investing more yourselves so that you'll have the questions to ask. And what happens with a lot of the brokers and the mutual funds and the advisors is some of you are a lot bigger than me in terms of your investments, and they may phone you when they have an idea, or they may phone you when they think you should get out of something. But for the most part, they don't do that. So you might want to make a decision yourself that some things are too hot and you should look to sell, rather than riding up and down, up and down, up and down. Market timing does definitely have a place, I think. Again, more people are convinced that buy and hold now isn't the mantra for all times. One other thing the person at CIBC proposed to me, they suggested a bond fund. Well, bond fund typically they go down in value when interest rates go up, and conversely. The best time to be in a bond fund is when you think rates are going down. Another thing you might want to take from this is try and look for the obvious. I don't think interest rates can go down very much from this level. Call me crazy, but given that they're near historical lows or at historical lows, they're not going to go into negative territory. The banks might like that. You leave your money with us, we're going to take 5% a year, but, just not going to happen. So when she proposed this to me, I said, yeah, but interest rates are low. And she said, well, the Bank of Canada says until next June they're not going to raise interest rates because they want to protect the Canadian dollar. They don't want it to go too high, is what I'm trying to say. So I suggest that bond funds are not a good place to be. She, and again, very smart woman, suggested otherwise. So you've got to sift through some of the advice and do with it as you want. Afterwards, I'm going to stay here for a few minutes to answer questions if you have them. I brought 3 of my books. The one I showed before, the Contrarian Investors 13. That's not the copy you want to buy, though. It's damaged now. Maybe we can do a deal. The Uncommon Investor 3, and that's one that talks about our investing system, but also has baseball. World Series between the Toronto Blue Jays and the New York Mets. I'm a big baseball fan. I used to be bigger. You can guess who wins. And the first book I wrote, the Canadian Small Business Survival Guide, that's now in like its 13th printing and does very well. Books are $25 for one if you want two, $40 for the two. And if you have questions about the investment letter, you can always phone us or email us. We're happy to respond. We're going to have one question, I guess. Yeah. Well, I think that ETFs are better than mutual funds because they have lower expenses. So, again, if you can get a lower expense ratio, better to do it there. Now, I have all kinds of friends and people I know. They don't want to spend time. They don't have the time to invest themselves. So they say, I want someone else to do it for me. And that's completely understandable. So if you have to travel that route, look for, again, one with the lowest expense ratios in the area that makes sense to you. But also remember, over time, things change. So at one point, it may be good to have an international fund. At one point, it may be good to have a commodity fund. But when commodity prices go absolutely crazy, that may be the time to sell that fund, that ETF, whatever. Now the questions are coming. Last question. I own Citigroup, and I bought it at $3 and change, but it's very risky. So we have to leave it like that. I'm getting the cutoff sign. Again, I'm going to hang here for a bit. If you want to come and talk, buy a book, happy to do it. Thanks for coming out.